Okay, thanks for tuning into Talking Point. I'm your host, Neeraj Shah, and the case for a chat today for our guest, Mrinal Singh, who's the head of alternates listed equities at Bandhan AMC. Are rate cuts hope dashed for now after the RBI bulletin that has come in? I think it's a key thing and a key question to ask. Could there be a surprise in the budget to induce an equity correction? Read tax changes. And the biggest talking point for the last 5 days, at least since TCS has come out with numbers, or maybe since Accenture has come out with numbers, is whether IT can log in further gains. Every single time in the last 30 days, IT is surprised positively with its performance. Can it continue? Let's ask that question to Mrinal Singh, like I said, head of alternates listed equities at Bandhan AMC. Mrinal, good having you. Thanks for joining in. Congrats on the change, of course. Would love to understand, Mrinal. We'll start off with the markets. I'd love to know at the end as to what do you do now in the new role. But at the start, let me ask you, do the valuations give you discomfort?
The short answer is clearly yes. Anybody with a fundamental background or approach to investing would find the aggregate valuations uncomfortable. But obviously, the more important thing is that the economic trajectory of the economy is very, very robust. So we're talking about Indian economy being the best story for the next decade. Having said that, the current valuation are encompassing a fair degree of near-term gains. So now it remains to be seen how and where can we see a superior acceleration to be able to create superior returns going ahead for the investors.
Okay. Mrinal, when I looked at what the RBI bulletin, for example, suggested yesterday, right? And there was a lot of talk around whether there will be a rate cut happens, but the neutral rate estimate is higher. It's very close to the current rates, and therefore at least the conversations around rate cuts might get dashed for now. Is it an impediment to risk assets, including equities, when we are in the midst of or at the start of the private capex cycle? Or do you think this is already baked in that there won't be too much of a rate action until maybe March, April?
At least from a market participant view, the expectation in the near term is no rate cuts. So partially it is built into expectation. I think the current high frequency data pushes the rate cut expectations a bit farther. So for the time being, both the participants in the markets in the Indian context are not expecting any downticks in rates from the policy makers.
Okay. So if valuations are discomforting, if we do not necessarily have measures like a rate cut, etc., is your estimate, Mrinal, of earnings growth of your portfolio or of the Nifty 50, because we need the benchmark to stay okay, is your earnings estimate per se strong enough for the markets to sustain? Or do you reckon that if not a price correction, we will now certainly see a time correction?
So, well, the near-term earning growths, the valuations are clearly much ahead of that. So it does pose a challenge. The market is showing a lot of momentum built by the retail flows. But then there are triggers on the way, I would say. The justification for higher valuations can be acceleration of growth and earnings. And there are enough things that can do that. We've been, as an economy, underperforming the potential. I think a lot of supply side initiatives have been done. In the last 4 or 5 years, we've seen a reduction in corporate tax rates. We've seen PLI in a significant way incentivizing capacity creation. Although we haven't seen a very large investments getting channelized in that direction, but I think at least from a policymaker's perspective, we've seen supply side initiatives. I think what remains to be seen is, if we can see some kind of demand side push. The upcoming budget could be an interesting thing to watch for that. If we do see demand side push, there could be significant acceleration in the economy, and it will reflect upon the growth rates for earnings, and things could look different potentially. But for the near-term data, as we see, a lot is already baked into valuation. That is a fact.
Got it. Okay. Mrinal, So what gives? I mean, if the market has to sustain, let's say, would it be imperative for the heavyweight sectors to participate? And we'll get to tech in a moment, but let me talk about BFSI, because a lot of hope for the heavyweight sector to start performing, particularly the private banking side. We've seen a bout of that, nothing quite significant, but yes, from the lows, certainly a swift move before the consolidation of the last 15, 20 days. These days, 15 days sound a lot, by the way. But what's next then for BFSI, for example?
So in my view, I think the most robust or solid theme for the Indian economy is what I would call gross fixed asset formation, be it housing, be it private capex revival, be it government capex, and consumption. So I think these are the four legs that will continue to drive at different pace at different times the economy. Now, lending is a second order play in this. I mean, you could potentially do government capex, private capex, or housing through cement, through lenders, or anything. So banking is going to be a beneficiary as and when the domestic economy volumes pick up. It already is in a way showing positive traction. So that would be a logical thing to invest money into. But then, having said that, I still feel that there are direct plays as well, which will definitely benefit where the runway is quite long. As I mentioned very clearly, that would merit investment from fund managers' perspective.
Okay. And an offshoot of that, Mrinal, I would love to understand how you think about it. There's a lot of focus around the non-lending financials, particularly on the capital market side. Typically, if I'm not wrong, I've heard you say in the past that where things start to see an increasing glare of the regulation, you got to be a bit careful. Now, I'd love to understand, do you believe that the regulatory action taken on select names in the last couple of years, is that a glaring enough action for it to raise your eyebrows, or do you believe the tailwinds are strong enough to kind of ride over that hump, if you will?
So very clearly, where we are in the market, the regulator will get more active. We're already seeing signs, and I think that regulatory action will only increase going ahead. It is merited also. Particularly in the market, we see a lot of speculative activity. We also see some kind of periodic spurious, malpractices that come out. So regulators' mandate is to obviously control or eradicate that. So we'll see more action. We will see that in lending business as well. So I would build that, if regulatory action is on the uptick, we would rather be with established names whose governance is pristine, and they clearly have seen cycles and are very well versed with the regulation and the interpretation that it brings.
Got it. Okay. Now, the other one, of course, is tech, right? And before I get into Mrinal, let me get in my colleague Rucha to talk about what came out of the Infosys con call, as also maybe some of the other calls, because she's attended all of them, and try and tell us the outlook painted by the IT companies thus far, at least. Rucha, good morning.
Good morning, Neeraj. So Infosys reported stellar results, as we all know. Beat on all the three fronts, revenue, margins, profits up. But let me talk to you about, and guidance also, like, yes, that is important stuff. The company has increased its CC revenue growth guidance for FY25 from about 1 to 3% of band to 3 to 4% of band, while maintaining the operating margin guidance at 20 to 22%. But let me talk to you about the con call highlights which the company gave yesterday. The company definitely seeing early signs of improvement in the US BFSI space. Now, BFSI is the segment wherein most of the IT companies receive the highest revenues from, and this has been a little bit of weaker vertical over the past 4 quarters. Even for this quarter, TCS had a weaker growth in the BFSI segment, but early signs of improvement for Infosys in this segment. But talking about discretionary demand, which has been under pressure over the last few quarters, this continues to be be under pressure is what Infosys management states. And mind you, the uptick in guidance is partly attributable to the inorganic acquisition of Intech, is what the company mentioned. So though the stock is up around 4% in trade today and the ADR was up around 8% today, but the management still says that discretionary demand is under pressure and they are not seeing any transformational projects or easing of budget by the clients. This is what Infosys is saying. But let me have a quick look on what brokerages are also saying on Infosys. Most of the brokerages are bullish on the stock with a buy rating or an overweight rating. However, CLS is the only one which has a downside of around 1% on the stock. Now, let me talk to you about what CLSA is saying. Strong deal wins and Intech acquisition will lead the growth ahead, and early signs of margin improvement as well under the new CFO is expected. Jeffries, however, also believes that there are initial signs of BFSI, and this will also drive the growth in the second half of the year. However, discretionary demand is still under pressure. So the talk of the town around discretionary still remains, Neeraj. This is what we have on IT sector as a whole.
Thanks, Rucha, for that. There has been, Mrinal, a sizable move, especially post-Accenture numbers, and it only got strengthened after TCS, and now Infosys also delivering, maybe even LTIMindtree actually. Are you constructive, or do you believe the valuations are now, because they are no longer as they were on June 1st, that the valuations are baking in the near-term positives?
So, well, the IT companies on a broader level have done better than the street expectation, and the market has rewarded them for it. For the near term, particularly the bellwether upgrade of expected revenue growth or the guidance has given more feed to that comfort. But do we think that the valuations are there? I would say on an absolute level, yes, but on a relative level, they still are better placed. They generally are businesses which benefit when US economy goes through a downturn. We get to see more offshoring. So the volume trajectory is good. And the near-term outlook, as the companies are pointing, remains to be positive. So overall, I would say that it merits a neutral stance, and selectively on a stock basis, maybe an overweight stance, based on where we think the valuations are for specific businesses.
Okay. Viewers, keep in mind that the stocks have rallied quite a bit already, the tech names. And for example, if you just try and look at what the YTD or the 12-month performance of Nifty IT versus the Nifty has been, for example, you look at this, the pink line is the Nifty 50, and sometime around April, I think the Nifty overtook the Nifty IT quite convincingly. But I think post this June 20th Accenture number performance, there's been a really sharp up move in IT stocks. So this up move that you're talking is seeing is the one that I was asking Mrinal Singh about. Now, Mrinal, one follow-up question there. Some of the ERD stocks are really priced at very punchy valuations. Now, they're obviously showing a lot better qualitative growth. Texture of growth is strong. It is still double digits in most cases. But are valuations prohibitive? I mean, my question is not whether you'll buy them or no. My question is, if you add them in your portfolio, would you take some money off the table because of the valuations that they're trading at?
So, well, very interesting question, Neeraj. The good part about the ERD business is that the purchase orders are long dated. So they do offer good visibility for a long term because that's the nature of that business. Those associations are not short-term oriented or 3 months, 6 months. They typically run for years. But then the other element of that is that there are no lumpy upticks and downticks that happen. Near-term valuations are more than conducive. I would say that the agnostic general IT plays are better placed than pure play ERD plays simply because the valuations are way too high.
Got it. Same question for defense, Mrinal. Heady run. I mean, somebody was telling me this statistic that the HDFC, one of the defense funds, whichever it was, had a 150% performance and still underperformed the benchmark simply because all stocks have done so well. My question is, again, a very strong growth visibility, but are valuations prohibitive?
Well, see, defense is a very peculiar place, and I've seen this space for 20 years, where there were hardly any defense names to pick in the market. Now we have plenty, direct and indirect plays. But see, defense is a completely top-down investing. I mean, the very nature of that business is that, a lot of details are classified. And defense is a sector where, economic rationale is not the only driver of business. It's a sector where performance is far more important than the economics, because that is to do with national security and whatnot. So, well, it is very difficult to actually do meaningful, large-scale, bottom-up investing in defense per se. So, it is either a top-down investing, or it's, although we might have a view that, the defense spending is going to increase. Yes, the trajectory is positive. But then it is also, to a large degree, function of how the government financials remain. We have seen in the past that governments has deterred payments when their fiscal situation gets tight. So it has its own risk. Just because the defense spending is going to have a positive trajectory does not mean that things will be hunky-dory for the sector. I think it's an ultimate top-down investing space. Very difficult to do a broad level bottom-up investing. It's a perfect momentum vehicle and sector. You will see, fundamentally bottom-up investors not engaging in defense in a meaningful way, and the broader valuation at this juncture looks just out of whack. I mean, I just can't make sense given what risk it comes with. It just doesn't make sense to be in that space at this juncture.
Well, and for somebody who's looked at the pocket for 20 years, viewers, I think it's about time that you give some credence to that view as well. Mrinal, earnings season, else would have loved to chat more, but this is also very helpful what you've told us today. Thanks so much. At another time, would love to understand what's the new role like. Seems very exciting, so all the best for that as well.